Welcome to Catholic Economics. This week I'm going to be talking about the most recent jobs report and a couple other things related to that. So, just so you're aware, at the beginning of every month, the first Friday of every month, we get a report on unemployment, pay, and all of that sort of thing. And this one was pretty bad, and we kind of got an idea that it was going to be bad because before the government data that came out, so the government data comes out on the first Friday of the month. Before we got that data, we got something called the ADP report. And so ADP is a company that it's a research company, and they put out a national employment report that focuses on private jobs. And they do lots of breakdowns, and I'll leave a link to it in the show notes, but they kind of break it out by the size of the company and the different regions of the country and all that good sort of thing. That's really convenient and interesting, I think, in a lot of ways. And so we got that sign that the government jobs report on Friday last week was going to be pretty bad, because a couple days before that, on the 31st of July, the ADP report came in at 122,000 jobs added. And the expectation was, the analyst expectation was that we were going to get 150,000. And last month's report was 155,000. So there was an expectation that was going to slow down a little bit relative to the last report that would have been the end of June. And some of that could just be seasonality. Maybe there's just something about July where you add fewer jobs in June, or maybe things were there was an expectation of a slowdown to some extent. But in this case, the slowdown was much, much worse than we would have expected. And so this early kind of signal that we were going to get the economy is slowing down, at least in terms of employment, was pretty bad. And so I'm going to put up this tweet, and the third link is going to be this tweet from EJ and Tony. ADP, private payrolls rose 122,000 in June. Small establishments had marginal losses. So small businesses actually had losses in employment in June, which is really ugly in my mind, because this show is Catholic Economics. I want to talk about Catholic stuff, and I think one of the important things about an economics that's good for people, for the normal person, well, I think it's good to understand. There's nothing wrong with large firms necessarily, but it's also important to pay attention to small establishments, because typically people that run small establishments are less financially secure, in the sense that if something goes wrong with that one thing that they do, then they're going to be in pretty dire straits. And you also have a situation where the connection between the employer and the employee, which I think is a very important connection to have. It's much easier to have that good connection when you as the employee are closer to the actual employer, the owner of the establishment. So again, there's nothing necessarily wrong with a large employer, with a large company, but having that connection between employer and employee is all to the good. And I think if you read the major social encyclicals, Rerum Novarum talks about this kind of thing, and some of the other ones do as well, where the thing is, you want to having a relationship, an actual human relationship between the employer and the employee, is a good thing, because it contributes to solidarity and things like that. So then let's see. Annual pay increases dropped noticeably, with job stayers and job changers at the lowest rates since July 21st and May 21st, respectively. So the idea here is that from this ADP report, we get a little bit more granular data on raises and things like that. And what Antoni is saying here is that the annual pay increases that this report is showing were slower. Okay, so it's still an increase, but a slower increase than in the past. And so you have job changers. So presumably, if you're a job changer, then that means you're going to get a raise because you're going to a better opportunity for yourself, something that makes more sense for you. And so, job changers, you put them in a different category than job stayers. People that are just staying in their job and they're going to get a raise. Well, you wouldn't expect them to get as much of a bump in pay because they don't have that extra thing of, okay, I'm going to this new opportunity where they're going to pay me more. So I think there's clearly an issue there, at least from the ADP data. Now, maybe you think, well, okay, the ADP data is that, not necessarily reliable or something like that. Well, here's the thing. A couple of days after the ADP report comes out, we get the news that unemployment had increased to 4.3%. And the expectations were much lower than that. So unemployment, meaning that the percentage of the people who are in the labor force, how many of them are unemployed, like trying to find a job but they don't have a job, that percentage rose to 4.3%. And that's pretty bad from a historical perspective. So I want to take a step back first and look at the employment to population ratio. I think this is important stuff, and whenever I teach unemployment and stuff like that, I make it a point to explain these different mechanisms. But the employment to population ratio is basically, well, it's just what it says. How many people out of the total adult population are employed in some way? And what we have seen, I think it's very interesting, what we've seen in the last couple years. So really, I think in the last 10 months, there's been a clear downtrend in the employment to population ratio. And now again, this is Catholic Economics, that's the name of the show. On the one hand, you could say that people leaving the labor force is a good thing. Fewer people employed is a good thing. If those people are leaving the labor force because they are financially secure, they have an appropriate mentality with respect to material possessions and the things that make a good life. If they're leaving the labor force because they're going to take care of their family, they're going to take care of their elderly parents, they're going to take care of their children, they're going to focus on their family, that's all good. What I'm concerned about is that that's not actually what's happening. And there's a very important little tweak here in the government data, in the unemployment data, that tells you this. So, like I said before, the unemployment rate is the percentage of people who are not employed, but they're looking for work, okay, as a percentage of everybody who's in what's called the labor force. In other words, everybody who's working or looking for work. And so it's that looking for work part that concerns me. Now, you could say we definitely have this phenomenon of what we call the discouraged workers. So people who they lose their job and maybe they look for a job for a little while and then they just give up. And they're like, you know what, forget it. I'm just going to stay on government benefits and this is just all I can do. This is the best my life is going to be. And that's definitely not what you want to see. If you have a situation where you're looking at the unemployment rate ticking up, I don't think there's a great case for the situation we're in right now being very good. Because the fact that the unemployment rate is ticking up, that means that there's more people who are not working but looking for a job. And so what that tells me is that people aren't saying, oh yeah, I'm just going to stay home and take care of my elderly parents or take care of my children or whatever. They're not doing that. They're looking for a job. They used to have one, and now they're looking for one because they lost it. And so that percentage ticking up is bad news. And so if you just look back at the history, and again, links to everything in the show notes. But this for July, we were at 4.3%. In June, we were at 4.1% unemployment. May, we were at 4%. And if you go back, we've been in the high threes for quite a while, but since March, it has done nothing but go up. We've been increasing the unemployment rate since March of this year. And really, I think you could say that there wasn't much of a trend for 2023, that it was kind of flat. But if anything, it was headed up over 2023. And once 2024 started, that's when we really started to see these upticks. And so this is bad news. And I think there's a couple of other things to say. So one is pay. So the ADP report talked about the fact that raises are slowing down. So people who, on the average in the ADP report, people got a raise. They got some increase in their salary overall, but it was slower than usual. And I'm going to put a couple links, or maybe just one. I'm going to put a link into one of my favorite wage series, which is average hourly earnings of production and non-supervisory employees in the private sector. And the reason I like this one is because I like that focus on production and non-supervisory. So we're not getting kind of a sampling of everybody. We're getting a specific group. And that specific group is people who are, they're in these kind of lower level positions. And again, why am I focusing on that? Well, I'm less concerned about somebody who's already making six figures and their pay increases slow down, or maybe they get a drop in pay a little bit. Not a great thing, not a good thing, not something I want to see. But I'm much more concerned about somebody who's already kind of at that level where they're going to potentially have some financial issues if they lose their job. And this series has been around since 1964. It's been around for a long time. And so you can really go back and look at it. And with the Fred website, you can really play around and look at different things. And what I'm going to do is I'm going to put this up there in terms of the average hourly earnings times average weekly hours. So we kind of get an idea of like weekly pay. Because what can happen is, if you think about it, if you're an employer, if you're concerned about the way things are going in your business, well, you don't necessarily have to cut pay. You could maybe just cut hours. Just not have people in the building as much because, well, maybe your orders are lower, or maybe your inputs are more expensive, and so you're not able to produce as much as you were. And so I'm going to throw that in there on an inflation adjusted basis, just to take a look at that. And what we've seen, if we're just looking at earnings, the hourly pay rate adjusted for inflation, we've definitely seen that number come up. But the thing is, it's only started to rise as the unemployment rate started to kind of flatten out from the reductions that we had after the whole lockdown, right? So we had, back during the lockdowns, we had unemployment skyrocket, and then it came down over time, over the next few years, flatlined, and then started ticking up. Well, we really didn't start seeing pay raises in terms of hourly wages in this government data set until unemployment started ticking up again. And so again, if we're thinking about economic growth, we're thinking about people's financial situation being improving. Well, we don't want to see that the only time we're starting to get inflation adjusted increases in pay only when people are unemployed. We don't want that. We want people to be getting inflation adjusted increases in pay even when we don't have unemployment issues. I hope that makes sense. In other words, we don't want people getting paid more while only because the labor market's getting tighter, only because there's fewer people in those jobs. But I think that's what we're seeing right now. So to kind of think about the sort of broader context of all of this and maybe bring in some other measures. Well, for one, so I'm kind of recording this late. It's Monday. And today we had a massive crash in Japan, in Japan's stock market, the Nikkei index, but also here in the U.S. as well, in the NASDAQ, the Dow Jones Industrial Average, the S&P 500, the Russell 2000 index, all just absolutely plummeted today. And I'm sure some people will say, well, it was just Japan, contagion, blah, blah, blah. But I'm not 100% sure about that. I mean, there's been some issues with the tech sector over the past few weeks, and I think there's probably more to it than just, contagion from the Japanese stock market. And if I want to defend that, I guess here's my chance. So the latest estimate for the Atlanta Fed GDP now was last week, was Thursday the 1st. And they had that down at 2.5%. So they started off a little bit more optimistic, where they were at closer to they were at 2.8% in late July. And as usual, tomorrow they will come out with another forecast. And so I'll talk about that next week. But the forecast has come down. And I suspect that this jobs report that came out on the 2nd will factor in for the Tuesday, August 2nd update, and will probably come down to some extent, unless there's something else going on that offsets it in terms of data. But not good news, I don't think. And the fact that it's already coming down is that their forecast is already coming down. I think that's probably a worse sign. And of course, last Friday when the jobs report came out, you instantly had everybody kind of freaking out about it. So you had Austin Goolsbee from the Fed saying, "Oh, we don't want to overreact to 1 month's numbers." But you look at the CME Group's Fed Watch, which is it's basically a market-based prediction tool, and it's an indicator of the likelihood that the Federal Reserve will change the target rate, the target interest rate. So now we're talking about, okay, if the information that we're getting about unemployment rising is an indicator of weakness in the real economy, the weakness in the economics, the economic underpinnings of our society. If that's the case, then the Fed's response, the Federal Reserve's response, is probably going to be something like, let's lower interest rates so that we can stimulate business activity, or at the very least, that's their theory. Okay, that doesn't have to be your theory, but that's their theory. And so I'm just looking at this today, and of course, if you click on this on another day, you're going to have different numbers on here. But as of right now, the chance of reducing the Federal Reserve's target rate is 100% at their next meeting on September 18th. But the chances of that rate cut coming in at 0.5% or more is 84%. And 1 week ago, the odds of that, according to this indicator, was only 11%. So we went from an 11% chance of that happening a week ago to now an 84% chance. So now the market is sort of pricing in a much steeper cut in interest rates that, at least in theory, would be stimulative of the economy. And so that's an interesting thing to see there, that massive rise. And it was actually pretty high even last Friday, I think, again, based on the jobs report. But then today, you get the massive drop in the stock market, and that just added fuel to the fire. If we go out to the November 7th meeting, again, we're pricing in another cut. But by then, let's see, they're showing a 35% chance of that cut being more than right at 1 whole percentage point, which is absolutely wild for that to happen over that short of a period of time. But I guess probably not too surprising. And then if we look out at the middle of December, we've kind of got an even odds of that rate being yet even lower than that. So maybe a 1.5, 1.25 to 1.5 point cut by the end of this year, which again is pretty dramatic. And we'll just sort of have to see if that helps. If obviously there's different things to talk about there. If the rates come down, well, maybe that puts a little bit of support on home prices. That alleviates a little bit of pressure for people that are in debt. But at the same time, it's kind of a wacky tool to use because, again, we kind of risk just reaccelerating inflation. So inflation's still an issue. Inflation's still above the Fed's target. I haven't talked about inflation in a couple weeks, but the fact that we still have inflation running hotter than we want it to, and then the Fed's going to try to lower interest rates, well, in theory, that's going to push up inflation again. So a lot of moving parts there, but we're in a time where there's a reason why the Fed hasn't cut rates, and it's inflation. That's the reason. So finally, the last thing I wanted to include here, and this is something I'd never really heard of, but there's something called the SAHM rule. So SAHM is the last name of Claudia Sahm, who I believe is or was a Federal Reserve economist. And she developed this rule, and I'm just going to read here. The SAHM recession indicator signals the start of a recession when the 3-month moving average of the national unemployment rate, so that's what we were talking about before, we were talking about the unemployment rate, rises by 0.5 of a percentage point or more relative to the minimum of the 3-month averages from the previous 12 months. So that's a lot to sort out. But basically, if you just look at the broad picture of this thing, it's an interesting indicator because it starts to rise during the recession. And the thing about recessions is, because of the way we define them, which is 3 consecutive quarters of negative GDP growth, you don't really know you're in it until after, because we define them in an after sense, in a post hoc sense. So we look back and we say, well, gosh, we were in a recession during XYZ time frame. But if you look at this very generally, it does actually tick up when the recession is going on. And really, so where are we at now? Well, this index is at 0.53 for July. So based on the July unemployment rate increase, this rule predicts that we will have been in a recession at this time. And so you go back and look, okay, at what points in the past were we in that same range? So it's kind of hard to, it's a little weird to look at the 2020, but gosh, March of 2020, this thing was at 0.3. And then of course, by April, it just skyrocketed of 2020. But if you remember back in April of 2008, so April of 2008, this index was at 0.5. And again, we're at 0.53 right now. So it's worse now than it was in April of 2008. It's worse now at it's the same now, at 0.53 as it was in June of 2001, the dot-com recession. It was at 0.5 in November of 1990, another recession. Not one that I remember personally, but the early 80s recession in 1981. And so several times in the past. So the SAHM rule was indicating, and again, economists can construct these indicators that do a good job of predicting the past, which is sort of useless, but it sort of remains to be seen if they can predict the future. And so while this indicator was very consistent in 2020 and it made sense in 2008, made sense in 2001, we don't really know if we're in a recession right now. And at the very least, the last GDP update did not indicate that we were in a recession at least for the second quarter of this year. Now, this quarter, maybe we are seeing that flashing red recession indicator. So it remains to be seen, of course, on that. I think this is an interesting tool to look at, and it's probably something I'm going to refer to now and then, kind of like I do with the Atlanta Fed GDP Now. But this one's going to be clunkier because it's only going to come out once a month when we get the jobs report. So thanks for listening. I hope you enjoyed this. If you have any questions or thoughts or whatever, just leave them in the comments, whether it's on Spotify or YouTube or however you're listening. If you want to email me, it's lrussell@leoinstitute.org. And I look forward to hearing from you, and I look forward to putting out another episode next week.